Happy Friday, everybody.
Hey, happy Friday.
Hey, Alex, welcome.
How's it going?
Good. How's the deal going?
We're moving along. It's I think we're still probably targeting end of July, and I'm actually going to be meeting up with him with the seller for lunch in a little bit, so I might have to drop early, and yeah, it's progressing very positively. So in probably 3 weeks, I'll be meeting with the rest of the key employees and just letting them know that I'm going to be the new incoming owner and getting some buy off on that and just working. We got a draft of the purchase agreement, so we're expecting feedback from sellers council on that, and probably a week or two away from credit memo with First Internet Bank.
Awesome. Congratulations.
Thank you.
How has sorry, go ahead.
I was just gonna say, you mentioned Whip last week in the last call. He's actually gonna provide that to me today in person.
Okay, great. Yeah.
Yep.
How do they track backlog? Like unsigned LOIs?
Yeah, he's gonna provide that to me too. They've just got kind of a running list of potential projects, and then just tracking notes whether they've made the bid, whether it's still open. They're tracking a lot of different deals.
Great. Just on the closing, I know I've mentioned this in the past, but I'll mention it again also for the benefit of other people on the call. At this phase you're at, this sort of end closing area, a lot of the work really only gets done in sort of the 2 hours before and after meetings with bankers. So you may want to, if you're kind of leading that process, you may want to just try to organize and structure multiple meetings. My rule of thumb is usually at least one a week until you're within 30 days of your target close date, and then probably 2 to 3 a week. And then once you blow your close date, which most of the time people will, every day.
That's really good to know. Yeah, at this point we've been keeping it consistent with once a week, and I'm meeting with Aegis, I'm meeting with First Internet Bank, and then I have updates to take into my weekly due diligence call that I have with the seller and the broker, just saying here's where I'm at in my process, how's everything looking on your end, and but yeah, I think the closer we get to that ultimate close date, it's going to be, and we get the credit memo and feedback, if there is anything on that, then yeah, we'll really have to hit the ground running quickly.
Mm-hmm.
High communication.
All right, well, it's 5 past. Smaller group today, but let's chat raising equity. As usual, this is more, I think it's probably more of a conversation, because I think both Rich and I have done this in different ways. And also just to take a lot of questions you might have about raising external equity, whether it's from friends and family, whether it's from more institutional people, what that looks like, and what that looks like in conjunction with an SBA loan. So I think that the first question, if you're going to raise equity, is who are you raising the money from? And so I would say there are institutional equity investors, especially sort of in the search fund world, right? And a lot of them will hang out in Search Funder and a lot of these other places. And they're typically targeting, like a 20% IRR, 20 to 25% IRR, and they're professional investors, right? They're targeting that number because, that's generally what they look at for other investments. Then there are high net worth investors, right? And I would say that's typically accredited investors that are typically, their alternatives are the stock market, bonds, real estate. And there, obviously the IRR there is significantly lower, so the perceived risk is also lower. So there's probably an argument that you could get a significantly lower IRR if you target those investors. I would say, so two things about that. I would say ask for a higher dollar amount, like have a higher minimum dollar amount with those investors, and make the investment as simple as possible. Right? Don't overcomplicate it with waterfall models and this and that. And then thirdly, and this is more in Rich's world, there are sort of more institutional investors like debt funds, and capital funds that are more than just an individual, which I'll let Rich talk to a bit more, but typically that's only going to be for larger deals. And so when I say larger deals, it's probably you're outside of the realm of SBA. You're probably looking at 2 million EBITDA plus, maybe even 3 million EBITDA plus. And then you're also looking at significantly different structures in order to finance that, because it's probably at around 5x. And we can talk about that as well. Rich, would you agree with most of that, or am I missing anything there? No, you're muted, buddy.
All right. Sorry, all. I'm in a van right now. That's where I'm conducting my call from. Yeah, you hit it spot on. I mean, the institutional market's going to be obviously a larger scale. When you start talking institutions, you're talking what you consider traditional private equity, private credit funds, that sort of thing. And they're looking for really to put a large slug of capital to play, and I mean, literally they're looking to put a minimum of, 25 million into a deal. So you're going to be looking at larger deal sizes. Obviously, those are going to be SBA type deals, but, occasionally you might come across an opportunity that you feel like, that's a great opportunity. You just have to be cautious that they're going to basically put you through the ringer because they're depending on you as the investor, and they're investing in you as the buyer of the business first and foremost, and then they're looking at the business itself and then how to best structure the investment to meet their investors' returns.
Okay, so those are sort of the three sort of sources of equity. Then comes the question of, how do you structure the deal? And we'll talk. Obviously, there's a myriad of ways to structure deals, but we'll talk about a few basics. So first, you can have a simple equity sale of common shares. Now, if you are selling equity in an SBA finance deal and you're selling common shares, there's typically a personal guarantee requirement if it's over 20%, or it's 20% or over of those common shares, right? That includes if there's retention of equity from the owner of 20% or over. SBA banks will treat ownership in various ways. So there are some banks, there's kind of two different ways. Some banks will basically look at voting control, right? So common shares typically hold the voting control. And so FID, which Alex is using, and sorry, not FID, FIB, First Internet Bank, is an example of such a bank. And then other banks will look at it as kind of economic control. And I know Live Oak does that. Outside of common shares, it's quite common to have preferred shares. And preferred shares, it's a separate class of shares. They may or may not include a dividend to your investors. Preferred shares are preferred in the sense that dividends are paid out to preferred shareholders first. In the event of bankruptcy, preferred shares are paid out before common shares are paid out. And then because of this, preferred shares will typically Well, as you sell them, they typically have a slightly different tax structure than the common shares. Anything to add there, Rich?
No, just yeah, I mean, again, you've explained it perfectly. Just I think people still forget that preferred shares, yes, they have a structure within the capital structure where they have seniority over common shares. And we'll get into more specifics later as we talk about kind of modeling. But when you guys are modeling these things out, just understand that even if you look at the Acquira fund or whatever investor that's out there, when they actually calculate their internal rates of return and what their required cash flow streams are from the business, just understand that before any dividends are going to be paid to you guys, they're going to come right out of the common share. The preferred shares are going to take their dividend first, and then you can calculate what your dividend should be. So it won't be on a even basis in terms of when a dividend's paid. Preferred gets theirs, they share in the common dividends. It's completely different, but we'll get to that. Most of you guys know that, but some of you guys this may be new to you.
And typically, if a preferred share actually holds an annual dividend, it would be on the total amount of the investment. So if someone says a 10% preferred dividend and the total investment's $100K, then it would be a $10,000 a year dividend.
Yeah, great distinction. It's not based on the cash flow of the business. It's based on the actual capital invested. So,
and then the final thing that you may see is basically it's called a SAFE, and it's in many ways similar to so a SAFE is basically an equity investment where the value of that equity is determined at a future date, and it carries no convertible note. So it typically will not carry any type of like interest-bearing note. I guess we should probably talk about converts too. It might be easier to start with converts and then move to SAFEs, actually. You want to talk about convertible notes, Rich?
Yeah, so if someone, a lot of times with these smaller deals, even some of the larger deals, what ends up happening is the investor will want the safety of a debt instrument, but also the upside of an equity instrument. So they'll invest usually with some sort of a convertible note. It could be a convertible preferred. It could be a convertible debt offering. It depends on really the investor's preference around that. But typically how a conversion works is essentially there's a certain amount of capital you might raise that goes into the business. And then the investor basically will put that capital into the business, and then they're basically investing with an option to convert. And what that option to convert allows for is there's a conversion ratio with whatever has been negotiated, whether it's a conversion, let's just say of each dollar of capital invested converts to 2% or 3% of ownership or 3x of the capital invested. Those terms can be kind of all over the map. And it's up to you to negotiate what you feel comfortable with. But effectively, they're just converting that debt instrument or that preferred equity instrument into a common share. So in essence, they become kind of a co-owner of the business with you. And usually it's once the conversion's made, then all payouts are basically based on a pari passu basis, meaning that whatever percentage each person owns or each entity owns in the business is basically how they will get paid out in terms of cash flow. So if you end up on the conversion, they end up on a conversion owning 30% of the business and you own 70%. When you go to do distributions, then it becomes a 70-30 relationship where you get 70 and they get 30%. That's the easiest way to explain a convertible instrument in terms of simple terms. There's a whole lot of nuance around them though, and there's a whole lot of bells and whistles that can be added. But from a simplicity standpoint, that's essentially what it is.
Yeah, and it would typically be used because you want to face minimal dilution, and you believe that there's going to be a strong accretion in value in the near term. And so instead of diluting yourself fully today, you'd prefer to dilute yourself in say 12 or 24 months because something in the future is happening, like you're going to acquire more businesses, or you're going to go public, or you're going to have some form of, liquidity through some other means, right? Okay, any questions so far? Please feel free to raise your hands if anything here. We're using lots of like acronyms and stuff, so.
None. I'm a smart group. They're absorbing it all.
Okay, so
Questions are
here?
like, woo, I don't know how to word them. So I'll throw something out there. So for the deals that we're looking, well, I don't know what everyone else is looking at, but the deals that you see for most of the people like me, like in this group, what's the starting point? Like what makes the most sense? And then what's the level of like, so some of the bigger deals seem maybe not as relevant unless you're doing like sort of a special big deal, but what does the rigor look like around like the analysis, the documentation? Are we going to get information out of a QOE that, like, for example, we could use to translate into a document that we would pitch something like? Hayden and I talked at the offsite about, friends and family, so I kind of understand that a little bit, but I just love to hear you guys' perspective on like what does that look like in the real world? Like how do you decide the approach, and then like how do you go about it? What information you need to come with? What does the pitch sound like? What are the questions likely to be in the challenges?
So I'll start, Hayden, and you can kind of jump in and chime in. So understand, yeah, and I think at the workshop, Hayden explained, kind of friends and family perfectly. There's not, typically with friends and family, there's not a whole lot of rigor around what they're, when they decide to invest with you, they're investing with you because they know you. They presumably, if they're family, they like you. Yeah, and that's not always the case, but let's just assume that that's the case. They're going to trust your decisions around it. Unless you've been really flaky in the past. But for the most part, there's a lot less rigor involved. Anytime you step away from the friends and family component of equity, you start to move up the realm of more, what I would call more, I hate to use the term, but it's just true. It's just more sophisticated money. And so the rigors that you're going to be, or the hoops you're expected to jump through, are going to be significantly higher. So to start with, let's just kind of use kind of a smaller company like Kelly, like for instance, your business that we looked at a while ago. If we were going to, someone was at that level, we're going to invest in the business. At the minimum, they're going to expect, obviously, they're going to want to know who you are. They're going to look at your background, your resume. They're going to want to understand why you want this particular business, what you plan to do with the business, how long you plan to hold the business, and what that potential exit, what the exit plan looks like. I mean, you'll quantify all that at some point, but in the very beginning, they just want to kind of have a general discussion with you to understand kind of who you are, what what you're about, what the business is, what your background, what the fit is. So, for instance, on that slide deck that we always prepare for IC meetings, there's that acquisition or entrepreneur fit. That's actually very important to an outside investor, because obviously when they're going to put their capital to run.
Oh, we froze.
Well, I guess I'll continue on the track he was on. Yeah, I think definitely the AE fit is important. If I'm an investor, I would ask about your relocation plans, if relocation is involved. Relocation is, I think the SBA did an audit of these change of ownership 7A loans, and relocation of family was the largest correlated data point to default, more so than lack of industry experience.
Is that because they did relocate and they weren't happy, or they didn't relocate and they were commuting?
Well, usually it's that they relocated their family, and they didn't have a support network. That's my interpretation, at least. I've certainly seen it happen with AEs that relocated. and there's just so much change and chaos you can take in your life at once, right? From the financials perspective, again, if we're looking at more sophisticated investors, they'll want to understand, they'll want to see models that have sort of a downside scenario, right? So they'll want to see, like, I usually will give like a haircut model and then a super haircut model that shows that even with a super haircut, like, this business can pay its debt.
Yeah.
Right. Because ultimately, if it's an SBA deal and you pay your debt, your investors will all get a good return.
Yeah.
Right. So yeah, I mean, those are the main things. Chris is the GP of Acquira Capital, which is an equity fund, and he'll always have an interview with the AE, typically post LOI, post QOE, and sort of he'll ask a bunch of these questions, right? And he'll ask about operations. Welcome back, Rich. He'll ask about relocation. He'll ask about the key staff. He'll ask about where the risks are, what key man risk is, what concentration risks exist. What will you do if this person leaves? What would you do if this customer leaves? Like, those are all, I think, good questions for an investor. If you're working with friends and family, yeah, there's likely some implicit trust there. I would still say, though, prepare the data room as if an institutional investor was looking at it.
I apologize. Apparently, my iPhone started to run hot and it just shut me down. So gotta hold it near the air conditioner. Okay, so I don't know where I left off and where you picked up, Hayden.
I just continued your thought, I think, on questions about AE fit and relocation and stuff like that.
Okay, all right, yeah. So they're gonna look at all those things, and then and really that's really, it's obviously you as AEs, you guys, I think all the training kind of prepares you to answer most of those questions. I mean, your deck, just to prepare your deck will prepare you for a lot of the questions that they would ask specifically about the business, and maybe even a little bit more about you as far as entrepreneurial fit. But the deck does a great job kind of highlighting the areas that any investor is going to focus on. Now, beyond that, what's going to end up happening is as you kind of get through the process, you're going to have to be really detailed about every significant data point that you provide to an outside investor. So what I mean by that is, obviously, we encourage you to get the QOE. That's going to help with the analysis on their end. Obviously, with the analysis on your own part too, as well, to make sure that there's nothing hidden in the preliminary information that you looked at. But they're going to want to understand that. They're going to want to understand that. Yeah, obviously, they're going to want a copy of the LOI to understand the structure of how you plan to invest in that business. They just want to have a general framework around that. But then you're going to get into like real detail. So we do like a modeling for SBA lending. We have the SBA calculator, and a lot of lenders accept that model to actually determine whether they can, if your assumptions are reasonable around them making a loan. Now, obviously, they build their own models from that. But when you start looking at kind of what I call sophisticated, a little bit more sophisticated money, your models are going to have to be really detailed and really tight and really hone in on the unit economics of your business, the assumptions around your growth. They're going to ask you about those. What makes you think you can actually achieve those if the business hasn't been doing that? What's your plan? If you're going to grow 10 to 15% per year, what's your marketing plan around that? Does that look realistic? How are you going to support that growth with the people that you hire? I mean, they're really going to dig in and expect you to have answers to that, and not just provide them with some sort of written business plan and throw it at them. Because they're not going to, I mean, they may read a summary version of it, but they're going to ask you about your plans and your model first, and then they may go and dig in on the back end just to make sure that what you're saying actually makes sense. And then after all that goes on, they're going to still be very tedious in the way that they write, their partnership agreements with you. They're basically, when they're ready to send capital your way, they're basically going to try to take your last child. So you have to be careful. They're sharks. Not necessarily saying that's a bad thing, but they're going to impose some disciplines on the business. They're going to impose some disciplines on you conducting the business, and they're going to write those into their agreement. So you should definitely make sure you have the right attorney on your side to make sure that they're reviewing those documents with you if you're not comfortable with it. From that standpoint, but it's really a very time-intensive basis, and it can take, honestly, if you're the smaller deals, like Chris from the fund is investing, that doesn't take a whole lot of time because he's prepared. We've done a lot of the analysis work for him from that standpoint, and he's watched your videos, your investment committees videos, and what have you. If you guys have done investment committees, he knows kind of what templates we use. He understands all of that. And so he's got a feel for all of that. So his decision making is a little bit quicker. But once you start kind of going out into kind of like the larger institutional market, it can take you literally from you starting at the beginning, the start line with your deal to get some equity to the end point. They can make a preliminary decision fairly quickly within about 30, 45 days or so. But then to actually go through the complete underwrite and to get the capital in hand, it can plan on 3 to 4 months. I mean, they're going to be that diligent in their approach. But yeah, I mean, Hayden, you have anything you want to add to that?
Yeah, so I was thinking, what are some of the outcomes I'd like for? So I don't know the experience level of everyone on the call, but assuming someone's relatively new to this, one of the outcomes I'd like to get out of this is at least you're noting down a lot of these terms that we're talking about, so that when the time comes, you can research them in more depth. I also do kind of want to scare you off of, as Rich was calling them, like sophisticated investors or institutional investors a little bit, because as Rich said, they will put in covenants that can be, extremely limiting. So there so there's covenants, there are actual terms, there are reporting requirements. All of these things can be fairly onerous. I can give examples of that. I know the first time I raised institutional capital was with an old sort of small private equity company that we had. We raised a debt fund that had extremely restrictive covenants. A lot of these covenants will basically put you into default based on like random things. Like everything will put you into default. And default in this case is now like extremely onerous interest rates, and it's not missing your payment. It's like, your DSCR dropped to a certain level, and this so and so thing happened and you didn't notify us, right? Which seems trivial. Or even you were working on something else, right? That wasn't your business. Like all of these things are covenants that are fairly common in a lot of sort of these funds. Go ahead, Mark.
Hi. Yeah, your first question about when you started talking about who's new to this. I'm 2 weeks in, so I qualify for that. And your scare tactic is working great, by the way.
Okay.
This doesn't sound like a lot of fun. I think that for me, like being a complete novice in this space, couple things. You talk about AE fit. I'm a corporate guy for dozens of years, scores of years. I'm not going to be a technical fit for an HVAC company. So when you talk about fit, what does that entail? Is it gravitas and general knowledge and ability to speak, or do you need to have some licensing and wrench turning to court and people like that in this space?
I think like technical skill set is one piece of it, but another piece of it might be leadership skill set, right, or finance skill set, or all these other pieces of business that aren't just the technical part of it. It can also be, if you're buying a business in your hometown, and you're familiar with the community, that's AE fit, right? And in many ways, that's a stronger fit than someone who has the technical fit, but is, coming from outside of the community, right? In
Right.
terms of at least a seller's point of view.
Yep.
Yeah, so I'd lean on that. And from the corporate world, if there's, leadership, if you've owned a P&L, if you've, managed, large groups of people, if you have sales background, if you've been exposed to marketing, all of these things are helpful.
Yeah. No, that's great. Thanks for that context. Again, being early into this, I'm starting to I'm set up on, a couple of the websites, so businesses are coming through. And from the thesis of being, around 750 to 2 million, waiting for those to come through, I'm finding everything below and above coming through.
Mm-hmm.
So my initial thought was that I won't need external financing, been able to squirrel away some things here over the last 2 years so I can do it myself. But it looks like there's something happening in the sweet spot that you sort of talk about, to where those deals don't hit the websites. Maybe the brokers have preferred buyers or investors that they get those inside deals. They're not loading them up to DealQuest and others. So is it likely that as a first-time buyer, we will be in the space of raising external capital?
It's entirely dependent on your situation. So as an example, you may only have $100,000 saved to invest. If you didn't raise external capital, that might require you doing a smaller business or having very creative terms, right? Which means having a flexible seller and probably no other buyers at the table, right? Which is unlikely in the sweet spot, right, that we're looking at. Now, if you're in the position where you have a few $100,000 to invest, and you can likely do a $3 million purchase price without requiring external equity, you may not want to take external equity. That being said, you may also still want to diversify a little bit by taking some external equity, right? And so I think it's useful to at least know what your options are. And you may be in a situation where the deal you find, you have 300,000 squirreled away, and the deal you find and is a perfect fit for you and happens to cost $9 million, right? And then you can figure something out. And so that's the purpose of understanding this.
Yeah, no, that's helpful. I'm sorry, Rich, about to say something?
Yeah, I was gonna say, kind of going back to entrepreneurial fit for a second. One of the things that people should really think about when they're trying to decide if it's a fit is whether, if you're looking at an opportunity, a business to buy, if there's if there's a problem that you've identified and it's somehow solvable, and you have some sort of background in that area, whether it's a financial management problem, whether it's a sales problem, whether it's an operations issue, and you've got that background, that might be your fit. So it's like your superpower to solve that particular business's problem could be the fit regardless of what industry you come from. So it doesn't have to be industry specific. Like Hayden said, if it's a leadership problem or you've got leadership skills, that might be the superpower to get that business turned around. So every time you look at an opportunity, sometimes I think people limit themselves in looking at opportunities, whether they're too big or too small or they're in the wrong industry. I would, obviously industry experience matters to a certain extent, but if you can figure out in your analysis, your preliminary analysis of what the issues around the business might be, then, if you've got a background around that area, then the business, even though it may be a non-traditional industry, may be a good fit for you.
That's brilliant. And I might be taking you off topic, Hayden, so I apologize, but that's a great answer. I mean, listen, not every CEO of a pharma company, not many have been in the lab before. So I think that problem solving skills is appropriate. I appreciate your answer also, Hayden, about the individual situations here. While you might have that 300, if you want to do a roll up, if you put it all into one deal, you kind of lock yourself out of thinking about other opportunities. So that's super helpful. So thanks.
Yeah, so I think we were talking a little bit about covenants. Yeah, the other item I kind of mentioned briefly was just reporting requirements. Again, I would say, friends and family, high net worth individuals, your reporting requirements would be fairly minimal and your covenants would be fairly non-existent. And that's ideally what you want. The other thing to talk about is timeline. So what's the timeline for when do the investors get their capital returned, right? And so for that, most people will want their capital returned in under 10 years, right? I'd say it's pretty common to say it's more like 5 to 7 years. And so you need to understand how that's happening and how the business supports it, because what we talk about, which is buying these business with an SBA loan, that loan is taking up a lot of that free cash flow, right? And the sweet spot return for most people is, I'm going to buy this business that currently has one buyer universe that trades at 3x SCE, right? I'm going to grow it so that it enters a new buyer universe, which is at 5x SCE, right? And I'm going to sell it, or I'm going to get some form of liquidity, right? We can talk about other non-selling forms of liquidity. But these are things that are really important to understand. If you don't plan on selling the business, but your investors want to receive their money back in 5 years, how does that happen? Right? Who's the buyer? Are you buying it back from them? Where are you getting that capital from? Right? Are you gonna leverage the SBA again and sort of refinance and get more debt on it? These are all things to consider. Some of the other, if you don't want to sell, or if you want to sort of retain that flexibility, which you should, some of the other ways to get liquidity, so to speak, is you could, if you grow the business large enough, you could do an ESOP, right? Which can be fairly tax efficient. So you could also do a second round of financing to do a roll-up, right? And do further acquisitions. And part of that, round of financing, which ideally, you buy business number one, let's say it's worth $3 million. Let's say in 3 years' time, you've grown it, it's now worth $5 million, and it's management run. You find business number two, it's another $3 million. Now you go raise a second round, assuming the value of business number one and business number two, which is a higher valuation. You're now basically extracting the value of that 5 million that you've grown in that valuation to raise money that could repurchase or purchase shares from that other investor, right? So that's one way that investor could get their money back. And that's typically the common way. I'd say most AEs, when they buy a business, their next thing is, okay, now I want to do, a roll up, or I want to do at least a tuck-in. And then again, if you've grown the business and you just want to do, raise money again, just at the higher valuation, you can do so.
It's much less dilutive at that point.
Yeah. Any questions on that, or on the roll-up side, or even on sort of the buyer universe side? Okay, I'll just give an example for people who might be newer, but typically a 750K SE trades at 3x ish, right? I'd say 1.5 million SE trades at 4x ish. And between those, there's a bit of a spread. Sometimes you can find, depending on the industry, sometimes you can find that $1.2 million SE business that still trades at 3x. It's getting a little less common. When you get towards 2, you're definitely trading around 5. So when we talk about the sweet spot, we are talking about sort of this, still too small for institutional investors and trading at, I would say a sub 4x multiple. But there is a pretty large difference, in my opinion, between a 3x business doing 500K a year and a 3x business doing $1 million a year, because you may only need to do 20% growth for 3 years to then get liquidity at 2 turns higher multiple. And that's very achievable, in my opinion, for most people within 5 years. And then there's the question of, okay, what does that liquidity look like? Okay, let's talk about compliance. So if you raise capital, you want to do a 506 offering. It's to be compliant. It's not expensive to do. The 2 common versions are the 506B and the 506C. In both cases, you need to raise from accredited investors. However, who accredits is different between the 2. So I would typically, unless you have like your own databases and websites or whatever, I would typically recommend you do a 506B. That does not allow you to market at mass to your investors. You would have to have one-on-one conversations, but it allows the investors to self-accredit, meaning they simply say, "Yeah, I'm an accredited investor," and
I didn't even see them.
And
Sorry.
sign something. Rich,
No,
did you just
sorry.
kill some?
No, I didn't kill anybody, but
So, whereas a 506C, the actual GP, so in this case you, would have to accredit your investors, meaning you have to actually collect tax returns typically to determine that in fact they are accredited, which at least from a conversion point, a conversion rate standpoint, will it'll be harder to do. And the benefit there is that you can have you can market at mass to investors. So there's a bunch of different, this is all part of like Regulation D. There's a bunch of different specialty firms that will do this for, it's a commodity at this point. We'll do it for a few $1,000s. And yeah, you need like a subscription agreement, you need a PPM, a private placement memorandum, and a few other things. One thing to be aware of if you're using SBA is seasoning. So you will need the equity required to do the deal seasoned in a bank account or across various bank accounts for 3 months, and you'll need to prove that to the SBA. So if you're going to raise money to close a deal, you want to raise it earlier or sooner rather than later. You can't sort of just leave it to the last couple of weeks before close, because they want to see that money seasoned. Okay, now in terms of the actual terms, so I mentioned this from like an IRR standpoint, but I'll give you kind of my preferred terms if I would be raising money from high net worth individuals, and I would, and Rich probably has his own opinion, so keep this in mind. This is just my opinion. It's nice to have multiple opinions, but in my opinion, I like raising a preferred, selling preferred shares with a dividend, typically at around sort of the stock market return rate. So let's call it 10%, right? 8 to 10%, with redemption in a period of time at a premium. So I'll give you an example. I'm raising $100,000. It's going to carry a 10% dividend. I have the option to redeem in 3 years at a 20% premium, meaning I'll pay you 10% a year, and in 3 years, I'll pay $120,000. As an example, right? If I don't redeem, they convert to common at a 30% premium, right? So they'll own more if I don't redeem. The reason I like redemption is, as someone who's raised money a few times, every investor on your cap table is a potential annoyance, which is why I say, raise larger amounts. Like, don't go, like, please, from experience, don't go out and raise like $10,000 checks and have a cap table with like, 50 people on it. Because it's going to be a nightmare.
Yeah, you'll have 50 different decision makers.
Instead, if you need 500K, go raise, 3 to 5 checks, right? And then if you have this redemption, you have the ability to replace that investor for whatever reason, right? I'd also make sure when you do the offering that you have drag along rights in that offering. So if you choose to sell the majority of the company, the investors and have some unique structure in the sale, investors will drag along. Rich, what do you think of that structure, and what are sort of some of your preferred structures for high net worth individuals?
No, I actually like that particular structure, and I like the reasoning behind that structure. I think it makes a lot of sense. Now, what I've tended to do in the past is I think Hayden's structure makes sense from an equity perspective, and I would definitely go that route. My tendency in the past, though, has been to layer an extra layer of what I call B tranche debt to acquire businesses. So what I may do is I may take us, and what that means is essentially, if you're looking at the capital structure of the business, and there's a senior debt position, let's just say, for purposes for you guys to understand, say that would be an SBA loan. It could be a conventional loan. It just depends. And usually it's going to be a conventional loan with the way I would do these deals. But you'd have that senior loan in place. You'd have my equity contribution. Now, and then my equity contribution, if I don't have it, I definitely would use Hayden's kind of approach to raising equity from that standpoint. But if I have enough equity where a little bit more of a kitty to put into the deal and I can keep other equity investors out, what I'll tend to do is actually add on additional leverage to like a mezzanine loan. But I will usually get the mezzanine loan structured without interest payments. So in effect, they become like equity investors because they'll get the kicker at the end and maybe a little bit of interest along the way, depending on how the business does. But for the most part, they'll be sitting in terms of a cash flow position, in terms of receiving any of those cash flows in the same position that I am. Usually not a whole lot unless I declare some sort of dividend, which would then trigger some covenants within the mezzanine loan agreement that I would pay some sort of accrued interest, possibly, depending on how that's structured. And then obviously at the end, when I decide to exit the business or I refinance the business, then that's where their kicker will kick in. So I'm almost like an equity return. So there's I think from an equity raising standpoint, which is really what we're talking about, Hayden is absolutely correct. His structure is probably one of the better ways of raising capital that I agree with and that I've seen in the marketplace, because you do want to have those redeemable rights to basically boot someone if they're just a problem, or just the option, for whatever reason, to remove that investor. But then once if you're really looking at buying a company and you've got enough capital on your own from an equity standpoint, then I'm really talking about kind of filling in where that gap in equity might fill in. I typically will use kind of like mezzanine debt, but now that caveat being said, most of the personal deals I've done have been a little bit larger than normal. But I think even kind of down market now, you're starting to see some of these mezzanine lenders come down to kind of what I would call a smaller, like $7 million enterprise value purchase, that sort of thing. So I'm it's one of those things, Abe, where we're in 100% agreement.
Great. Just for those who may not know some of these terms, so mezzanine lender would typically be a lender that comes in junior to your senior lender, and they'll typically come in at, let's call it 10 to 30% LTVs. Is that right, Rich? More or less. Yeah. And higher interest rates, and the kicker that Rich is talking about is an equity kicker. So it might look something like this: for every dollar that they invest, they might get 10 cents of equity, as an example, right? That would be a 10% kicker. One thing to keep in mind if you do go that route is that is additional debt. And so if you do have, let's say the SBA, looking at specific financial ratios, like maybe your debt to equity ratio or even DSCR, that may look a little bit worse going that route as opposed to going to pure preferred equity, because that equity is still equity. That 10% dividend is not a requirement, right? It's just a requirement to do before you do any form of common dividend, right? So as an example, if during the first year, and typically most of these deals, hey Rich, you got a companion.
Yeah, I've got actually 4 of them. Guys just can't see them all.
Typically, some of these deals, sorry, I lost my train of thought there. Rich, what was I saying? I'm sorry, guys.
We're talking. Don't worry about it. We were talking about the leverage. That basically the SBA would
right.
count the leverage into the.
Yeah, so a preferred dividend, if in the first year you can't make the preferred dividend, that amount will accrue, but it will not accrue interest most of the time unless something is specifically specified. So let's say you raise debt, you raise preferred equity with a 10% dividend. You decide not to make it this year. That'll carry over into next year, maybe, and before you can issue a common dividend to yourself, you'll have to issue that preferred dividend out. The other common structure, and this is the structure that Acquira Capital uses, and I also encourage you to go, there's a thinkific training about this on raising equity, and there's another one on Acquira Capital. But the other sort of common structure is where you raise preferred equity, and there is a conversion of that equity to basically to the value of the business. So rather than being dollar for dollar, the way Acquira Capital does is they take $2.50 for every dollar in terms of their equity conversion. Whereas you if you're putting 10% down as the primary owner with the SBA, you're basically getting a 10-to-1 conversion, right? You're getting basically $10 of value for every dollar you put in because of the leverage. So yeah, that's typically that's what Acquira Capital does. Now, Acquira Capital has some other pieces to it that will be more costly to you and give a return to the investors. But that's also if we recommend that you raise equity from like within the Acquira ecosystem, that would be the other, like another AE or something. That would be a pretty common way to do it, would be to take that same kind of structure, or do it the way I mentioned previously with a redeemable preferred. Any other questions? I feel like
Talk about this all day. Now, what I will say is, look, if you guys have some deals that you're looking at and you're worried about filling that equity gap, then talk to Hayden or myself. At least let us look at the deal with you. Don't just kind of discard the deal as it's too big, I don't have enough money or what have you, or capital, whatever. Talk to us about it, because it may be a deal that, even if Acquira Capital Fund doesn't participate in, we have other, investors that may have an interest in partnering with you. Obviously, you'd have to kind of meet with those investors and understand what their deal terms will look like, and we'll help you review those as well. So don't feel like you're out on a limb by yourself. That's what we're here for, and we can definitely help with finding those that are appropriate for those types of businesses, as well as kind of helping you review ultimately those term sheets to make sure that there's you can live with another investor on board. Because again, their terms are going to be all there's some standard ones, but then there's some that are really, there's some investors out there that are really, they may provide a slug of capital with the intent that you're going to do something to violate some sort of covenant, and then they ultimately own the business. So you got to be careful of that sort of thing as well. But for the most part, I mean, the investors they're all optimized to be looking for 30% plus returns. As long as you can show them how they can get to that end value. There's a lot of good opportunity, and there's a wider marketplace out there for equity investors, and more than people think. So just reach out to us if you need some help around that.
I'm going to spit out some random data points here just so you can take these notes if it's helpful. So the SBA 7A maxes out at 5 million, right? So that's for the business portion. If there's real estate included, you could get a 504 loan on that. There are banks that do pari passu loans, typically up to an additional 2.5 million. Live Oak is one of them. So if you're looking at a deal and it has a $9 million purchase price, you don't necessarily have to write it off because you could get 7.5 million in senior debt. And then you could have a decent amount of seller financing to cover a bunch of it, such that you actually only need to come up with that 5% equity. And 5%, that's 450K. Maybe that requires raising a few equity checks. Maybe you can do it on your own. If you want to do anything outside of the SBA, you're almost definitely going to require more equity or a much larger seller note. The loan to value on conventional loans is going to be more like 40 to 50%. So you're going to have to come up with the other 50 to 60, which can be some combination of seller financing, equity, seller retention, earnout, or yeah, I mean, that's about it. There are marketplaces for debt placement. Cerebro Capital is one. They do charge, but basically, if you have needs for a larger transaction, that's something that you could look at. They charge, I believe, they charge around 9K or something like that, and then they'll typically take like a point on whatever they raise. Most of the time, that will not make sense unless you're raising close to 8 figures. Anything else? No, I think that's it. And like Rich said, if you have questions about this, please feel free to reach out. You can reach out. You can message on Slack as well. That's probably the preferred route in like a group channel, so that the answers can benefit everybody in the community. And yeah, hopefully this has given you a bunch of things, a bunch of notes and stuff to research as you get further down the road, and sufficiently scared you from institutional investors.
Mission
Stay
accomplished.
away.
Yeah, well done.
Great session, guys. Appreciate it. Thank you.
Yeah, this is really good. Thank you.
Yeah, thank you very
Thank
much.
you. Cheers.